Hey, it's Jim, and this is level 1 of the CFA program, the topic on financial statement analysis and the learning module on analyzing balance sheets. You may be tempted to think that this learning module covers the entire analyzing of a balance sheet, but that's not really the case. If you're thinking that we're going to go from the top left to the bottom left and then the top right to the bottom right of the balance sheet, you're mistaken. Let me just remind you that the Institute has those refresher readings. So if you need some reminder on how to analyze accounts receivable or inventories or maybe property, plant, and equipment or accounts payable, stop the video right now and go back and take a look at that refresher reading. But as you look at these learning outcome statements, you'll notice that there's very little reference to top left and top right of the balance sheet. What we're going to do is focus on a couple of things here: intangible assets, and then corporations and businesses can invest in stocks and bonds just like you and I can. So we'll look at financial instruments, and we'll take a look at non-current liabilities, and then we'll end just like we did in the analyzing income statement learning module on common size balance sheets and related financial ratios. So let's go ahead and start with intangible assets. And I'm going to tell you just a quick personal story here about how to identify intangible assets. My father, and maybe you've heard this before, if you haven't, you'll hear it in level 2 and level 3, took me to my first James Bond movie when I was 5. And I was fascinated by Sean Connery back in the mid-1960s. He had the cool dress, he had the cool hair, even though it was a wig. I didn't know that at that time. And the way he moved, and, no matter what kind of a bad spot he got in, he always outsmarted or out-physicaled the bad guys. And he always won in the end, and he always had a happy ending with some beautiful woman out there. And I thought, man, this is what I want to be when I grow up. Of course, I have failed in that goal. But, the question then becomes, what was it about Sean Connery and James Bond that made him so cool? And clearly the answer is, well, he had something intangible. Couldn't really put your finger on it, but you knew it. You knew it when you saw it. So I'm pretty sure there's not going to be a James Bond question on your level 1 exam, but maybe, just maybe that story will help you in answering some of these intangible asset questions, because, look at this definition here for identifiable, separable or rise from contractual or other legal rights. Look up at the top there, without a physical substance. I mean, Sean Connery, he was a physical dude right there. But, Terrence Young, the director of Dr. No, turned Sean Connery from kind of a rough farming, country kind of a guy into this coolest guy that was ever showed up in Hollywood. Now look at some of the examples. You probably know this: patents, licenses, trademarks. If you have a minute, go to the CFA Institute webpage and you'll see lots and lots of good stuff about the CFA trademark. And let me just remind you, we'll go ahead and cover this in another learning module, that if you look at my name, it has James Forgen, PhD, CFA. Now that's the appropriate use of the CFA trademark. Now, of course, I could have typed out Chartered Financial Analyst. What I couldn't do, what's not appropriate, is I couldn't do C.F.A. And there's some other things that we'll learn in those ethics and professional studies learning module. But, think about this intangible asset in relation to the goal that you guys have, right? We're just starting out here in level 1. What's the goal? Pass this, pass level 2, pass level 3, get the, necessary work experience so that you can use that designation, right? Now, the other part of this is that there are some intangible assets that are not separately identifiable, and this is really an accounting treatment of what happens when one company takes over another company. And let's suppose we have a target company that's worth $100, and this acquiring firm comes in and takes over this acquiring company for $100. Well, that's the fair market value. So there's really no goodwill that results from that transaction. But if the acquiring company comes in and pays, let's say, $160 for that target company, well, there's $100 worth of, just regular old fair market value, but then there's $60 of something else. And so the accountants came up with this name. I have no idea when it was. I should know the history about that term goodwill, but I don't. Whatever that thing is, you have to call it something, so we call it goodwill. That's an intangible asset. Now, these intangible assets are going to have useful lives, just like a piece of equipment or a truck or machinery down at the bottom left of the balance sheet under property, plant, and equipment. And so if the intangible asset has a finite life, well, then it looks an awful lot like depreciation on a machine. But we can't call it depreciation. We depreciate a physical asset. We amortize an intangible asset. And so look at that first bullet point. Amortize systematically over an estimated useful life. Now, remember that, and you should learn this from those refresher readings, that when you have, let's just say a truck. Suppose I'm Jim's concrete company and I have a bunch of concrete delivery trucks. And so what happens over time? Well, I'm going to amortize that physical asset, that physical cost, because essentially that cement truck is going to just lose value. Now, the interesting thing about the accounting treatment of this is very different than what we experience when we buy a new car and we drive it off the lot. It immediately depreciates, and then if we sell it, a year or two later, we're not going to get something above, the price that we paid for it. We're going to get something way, way below. Now, that's a depreciation on your physical car, but it's not the same depreciation that occurs in businesses, because look, my truck, my cement truck, even though it might be 5 or 10 years old, it may still be able to deliver, because I have maintained it, it may still be able to deliver the same amount of concrete that it did 5 or 10 years ago. So what we have is we've got this impairment principle for property, plant, and equipment. And so the amortization thing for these finite useful life intangible assets is very, very similar. We say something like, okay, Jim, is your truck, is it worth more or is it worth less? So we can impair it. And we can say the same thing. Here, let me go back here quickly. We can say the same thing with a patent or a license or a trademark. Because those things can increase in value or they can decrease in value over their life. All right, so think about finite life. So that's going to be a key part of the question stem, finite life for this intangible asset. So just think of all the stuff that you know about depreciation expense. Now, if it's an infinite life, because, well, I'm guessing, I don't know this to be totally accurate because CFA Institute is nonprofit, but I'm guessing that CFA trademark is probably infinite because the Institute expects to be around forever and ever, right? And so this is not amortized, but we have to have that annual test for impairment. Now, let's look at that second part of the LOS up there. What are the disclosures? So we need information about useful lives. We need amortization rates and methods. And by the way, the Institute's not going to ask you this question. At least I can't imagine that they would, under which they would say, hey, here's a patent. Should it be amortized over 5 years or 10 years or 15 years? The reading, kind of says something like, hey, let's just use 15 years, although there's some, other kinds of ways to do it. But I don't think that is the really important question. But you need to know the rate and the method so you can get a sense of the decline in that value of the intangible asset. And then, and I think this is probably as important, if not more important than the first two, we need to know about impairment, and then we need to know when they're recognized. And then, of course, impairment can be reversed. You can have this intangible asset that loses value over time, and then something happens. Maybe it's something internal with the firm, or maybe it's something external out there, maybe some rule or regulation or law out there that changes it, and all of a sudden this patent, which was nearing death, all of a sudden comes out and it's worth $1 billion. Now you can report these things a couple of different ways. Look down at the bottom bullet point. So this is an important one. The US GAAP permits only the cost model. So the cost model is, hey, how much did we pay for the patent? Well, there you go. It's just like, how much did Jim pay for his concrete truck? Well, there's the number, right? There's nothing you can do about that number. But we can also use this revaluation model, and this is only appropriate. And by the way, only the international group allows this. There has to be an active market for the intangible asset. So the Institute doesn't do a really thorough job of telling you about what is an active market versus what is an inactive market. So you probably don't have to worry about something like, oh, this patent has changed hands 27 times over the last year. Well, that sounds like an active market, but if it changes hand once every 5 years, I don't really know if that's active. You'd have to probably ask your accounting friends to make that determination. But I'm guessing the Institute will go ahead and say there's an active market, and then if you're an international firm, then you can use the revaluation model. Now, what about a research phase and a development phase? So under the U.S. rules, all of those costs in which they're internally developed, those should be expensed. But the international group says something like, what you can do is that you can make a decision on costs that were incurred in the development phase, and you can capitalize them. So remember that the International Financial Reporting Standards Group is very similar to GAAP, with those exceptions of in the development phase, and then there's some examples there. So I'll make sure you know those exceptions. Now, the acquired or purchased intangibles, those are capitalized on the balance sheet as distinct and identifiable. Now, they've got to come from some kind of a contractual obligation, but this is the scenario under which these look really, really similar to physical assets like my cement truck. So what are these cost expense? So you can read all these things, brands, mastheads. I wonder if the Institute would give you an example there. That's what, for those of you who don't know this is from newspapers. Do you guys even read newspapers anymore? Well, I'm going to pause and I'll say this, and you'll hear me say this multiple times in all of my recordings. You should be reading the Wall Street Journal every day. And by the way, I get nothing from the Wall Street Journal for saying that. And I say that because, there's tons and tons of information. And my father, before he died, he started reading the Wall Street Journal, maybe his last 3 or 4 years of his life. And he kept telling me, he goes, gosh, this thing is only, I don't know, maybe it was $2 or $3 a day back then. He goes, this is the best value I've ever gotten in my life. And sure enough, my dad was correct. But I read it for all that stuff. But I read the editorial page because those editors, they have a tremendous sense of humor. I laugh once or twice a week reading their editorials. Anyway, so you probably won't see mastheads because, not too many people read newspapers anymore. Publishing titles, customer lists. So you have a whole bunch there that you should know. So let's go ahead and work through a quick example. We've got one project and 2 projects. And who really cares what they are? Hydrogen fuel cells, new catalytic converter. That sounds like good stuff, right? So one's in the research phase, no prototype. Development phase. Okay, so what did I say back here? Let's go back here. Where was that? Right here. So look at that orange teardrop point. Development phase may be capitalized. So look at the question down at the bottom. Which cost will be capitalized or expensed? So let's do this. Since there is no working prototype and it's in the research phase, both the U.S. and the international people, they are throwing everything to be expensed. Now, the second project, on the other hand, it's in the development phase and it is a working prototype, but if we're using the GAAP, all of these things have to be expensed. So there's no difference between project 1 and project 2. But for the international people here, materials, equipment, and patent costs, they can be capitalized. Administration and depreciation, those are expensed there. So look at the bottom. Administration overheads and depreciation are always expensed. All right, let's move on to goodwill. And let me go ahead and remind you guys that Sean Connery established the peak of the James Bond coolness and intangible asset, and it's been on a decline ever since. Although some of you younger people may not agree with me, but it went down a little bit with Roger Moore, and it kept going down and down. But then Daniel Craig, I'll give him his due. He was pretty cool in those last movies, except for the last movie when he died. Oh, did I ruin it for you guys? Oh. All right, how is goodwill created? I did that earlier when we did the $100, right? And the $160. So what does it say? Yeah, based on their fair value. So if the acquisition price exceeds, there's the 160 versus the 100. So that difference of $60 earlier, that has to be accounted for somehow. And so the accounting gods throw it into goodwill. So you can have economic goodwill, which is probably not going to be a question on the exam. Look at that last bullet point. This is not recorded on the balance sheet. And goodwill, this is stuff like, hey, you know what? I'm going to go over and buy a Starbucks coffee because Starbucks makes the greatest coffee that ever lived. I made that up because I'm not a coffee person, but I know some people who are, and they love Starbucks. Now, this is what we're interested in, right? Accounting goodwill. This is related to accounting standards. And by the way, remember that depreciation expense and that accumulated depreciation is really the accounting method, the accounting theory of how to handle the decline in value of an asset, physical asset for property, plant, and equipment, and now an intangible asset with goodwill, how to handle that decline in value from a tax perspective. So you pay a bunch of capital today for a truck, or you pay a bunch of stuff today for a patent. Well, what you do is you capitalize those things over the life of the physical or the intangible asset. And by the way, this is a really good exam question. The reason that we do this is for the matching principle, because my cement truck is going to generate revenue over time. Therefore, you should expense it over time. And the patent is going to generate revenue over time. So you should expense it over time. So remember that matching principle. Oh my gosh, you would have read about that if you went back and consulted those refresher readings. All right, so look at that second bullet point, right? Capitalized and not amortized. Tested for impairment, and you have to disclose all this good stuff. So here is just a summary of what I've been talking about, really, over the last 10 or 15 minutes. So step one, determine total cost. That makes sense, right? Measure the fair value. And by the way, measuring fair value and then determining identifiable assets and their value, it relies on some kind of judgment. So let's go ahead and apply all of the code and all of the professional standards that we learn about in those learning modules to the measurement, because it does require some kind of a judgment. And then what we'll do is determine the goodwill as the excess of the cost of the purchase over the net identifiable assets. And sometimes there's a bargain purchase. I would know the bargain purchase definition for the exam. Here we go. Word of caution. I was just saying this. Management judgment. So what that management judgment can mean is that we've got judges over here, and then we have judges over here. And if we have some judges, the managers, if they're saying one thing and those people over here are saying another thing, you're trying to evaluate these two mergers or acquisitions. Oh my gosh, it can affect the comparability of those financial statements. So what was this learning module called, right? Analyzing balance sheets. So what we're going to do is we're probably going to try to remove the impact of goodwill. I don't imagine the Institute would ask you to actually calculate this, but look at some of the typical adjustments. So look for this excluding goodwill from the balance sheet, and then excluding goodwill impairment losses from the income statement. So remember that goodwill can have impact on multiple financial statements. And just like you and I can go out and buy shares of stock and bonds, so can corporations. And so let's go ahead and look at this next LOS about investments in financial instruments. So look at the bottom there: investment securities, stocks and bonds, derivative, loans, and receivables. Don't forget to throw this in here. I'm not trying to complicate our lives, but suppose if we're a U.S. company and these we invest in the floor of the New York Stock Exchange. Well, that's a super easy kind of a manner to identify the original investment. But if we're a U.S. company and we're going to Canada and buying these things on the on the Toronto Stock Exchange or the Tokyo Stock Exchange or the German Stock Exchange, then we've got to worry about foreign exchange risk and currency risk and forward contracts and futures contracts, all that kind of stuff. So the derivatives in there is likely to be related, doesn't have to be, but it's likely to be related to some type of an international investment. There's a good definition of a financial instrument at the top part of this slide deck. Can't imagine the Institute would ask you something like that. You know what a financial instrument is. But you can measure these two ways with the fair value, which is probably the best way to do it, fair value. And it can be applied to almost any security out there. The amortized cost probably mostly refers to bond issues because you have principal repayments, you have premiums or discounts, and then you can have some impairment adjustment. So look for a question on the exam about a bond that was issued at a steep discount or a premium, and then that adjustment, might be way different than using the fair value. Now, if we, according to the international rules, measured at amortized cost, so there we go, held to maturity debt security. So a loan, that's debt. Notes receivable, that's debt, really. And then an unlisted equity security, I'm not really sure, so is that private? Does that mean it's a private company? Does it mean that it used to be a private company and then it was a public company and now it's a private company? I can't imagine the Institute would mention unlisted equity securities. And then GAAP, those are the same things down there at the bottom. Now, if we measure these things at fair value, what we're going to do is we're going to throw them through this other comprehensive income. Do you remember, for those of you who watched the Analyzing Income Statement recording, I gave you kind of an image here, and I'm going to repeat it. Remember that image I said, think about the income statement really as a kind of a small or special T account that shows up in the equity portion of the balance sheet, because you have revenues minus expenses, then you have net income, and then that net income flows back to retained earnings. So it's kind of a mini equity account. Now, don't tell any of your accounting friends that I said that, but it's a good way of thinking about it, especially since businesses, the owners of businesses, what do these owners have? And shareholders, they have a claim on the income stream of the assets, and so it kind of shows up on the balance sheet. Well, explicitly here we're gonna do this. So this other comprehensive income, this thing shows up in the equity portion of the balance sheet. Now, it's not retained earnings. I think that's a really good question, but that's probably a really good question for maybe a CPA exam and not the CFA exam. So there's some good differences between the international and the U.S. rules. Now, what we can do is we can go ahead and throw them specifically on the income statement. So these unrealized gains and losses are recognized in the income statement. And there's some bullet points there to remember, debt securities, equity, derivatives. So this looks like that list that we talked about in one of those previous slides. So look down under GAAP. For the equity securities, there's fair value, profit and loss. That should make perfect sense on the income statement. But the trading securities, the trading debt securities, those are going to be measured through at fair value with that same kind of a process. So GAAP says there's really no difference between the equity and the debt. Moving on to these non-current liabilities. So you might think that these are going to be loans and bonds payable. Well, of course they are. So there's some definitions of this, obligations that are not to be settled in one fiscal year. That makes sense. So these are reported at amortized cost. Go back to your original accounting class from maybe even high school. I did this in a bookkeeping class when I was in high school. And then your very first accounting class in college. So what do you have? You have a bond issued at a premium or a discount. So you have to make those journal entries, because if a bond is issued at a discount, let's suppose it's 95 versus a par value of 100. Well, you issue the bond, you only get $95, right? So, but you owe $100. You have to do something with the difference. And so the accounting gods out there say, you know what, let's throw this into this non-current liabilities account. All right, so look over on the right. What are we reporting at fair value? Bonds issued, financial liabilities held for trading, derivatives that are a liability, and then non-derivatives, instruments such as those hedged. So those things that I was down at the bottom bullet point there, that's what I was referring to earlier with international transactions, with the currency risk and using a forward or a futures contract or an option contract or a swap contract to hedge those derivatives. We will have super fascinating and interesting conversations about hedging throughout 1 and 2 and 3 levels. Won't be as fascinating as my James Bond conversations. Let's move on to the non-current liability learning outcome statement. There's a simple definition. They're not classified as current, not expected to be settled within 1 year. So these are bank loans, notes payable, bonds payable. So most of the time, these are going to be reported at the amortized cost. So there you go, down in the purple on the bottom left. But in some cases, you can report these at fair value. And in those certain cases, you'll have to look at those bullet points down on the bottom right. So those financial liabilities that are held for trading, the reading gives you no examples here. So I thought I would help you out just in case the Institute goes ahead and asks you these things. This is probably something that sounds like maybe a short sale, maybe a repurchase agreement. Those repurchase agreements, did we do that yet here in level 1? But we'll do that in level 2 and in level 3. So that repurchase agreement is an important concept throughout the program. How about derivatives that are a liability to the company? These are mostly interest rate swaps, but they could probably be some other kind of a swap, maybe some type of a commodity agreement. And then these non-derivative instruments, and this is right out of the reading, such as those hedged with derivatives. So you have to take a step back and try to figure out what that means. So think about, and this is what I was saying earlier about currency risk, think about an accounts receivable that you have. That's a non-derivative instrument, right? You can sell your accounts receivable. That's called factoring. But what happens if those accounts receivable are in a different currency and you want to use a forward contract or a futures contract or something? So that's what those non-derivative instruments mean. So think about accounts receivable. You could probably throw inventory in there, but that's not as intuitive as accounts receivable, but they can be hedged with derivatives. Remember, those things are reported at fair value. So let's take a look at 2 quick examples. Bonds issued at par value. So what does this mean? You're going to issue these in 10 million. So you have 10 million in cash, right? So that shows up on the left-hand side of the balance sheet. And then you'll have a long-term liability of $10 million. And that'll be equal to the amortized cost. That's the carrying amount. But what happens if we issue these at a discount of only 9.75 million? So what happens? What happens over on this recording? So you still have the liability, right? So that's still 10 million. You still owe $10 million, but you only have 9.75 million of cash. So you have to throw $250,000 worth of a discount in there. And that 250 will be amortized over the bond's life. I'm always fascinated by these things called deferred tax liabilities because, as you know, I'm guessing you know this from that refresher reading, that businesses, they have one set of financial statements and then they have another set of financial statements. One is for tax purposes and one is to report to you and me as Jimmy and Jerry and Johnny and Jenny investor. So what happens when there's a difference between what's reporting and they get thrown into non-current liabilities or into non-current assets? Now, this section of this learning module is very short. So I'm guessing if you know this bottom bullet point there, that'll be sufficient for you to answer the questions on the exam. We'll get in greater detail as we move through the program here. So look at this temporary difference. And, sometimes these temporary differences, they last for so long that they become permanent. But in this quick example here, we've got an expense in year 1, but you can't deduct it until year 2. So what is the accounting treatment? What are the impact? Look at those 2 block points there at the bottom. Those are probably two really good exam questions. So know about, hey, which year is there going to be higher taxable income, and when is that deferred tax liability going to be set up? You should remember we had a good conversation on the common-sized income statement. So everything that I talked about in that previous recording applies here. What we're doing is we're going to say we're comparing 2 companies and they have different sizes for things like, well, what did we say on the income statement? Revenues and expenses. Well, now the 2 companies are going to have different assets and different liabilities and different equities. So we throw them into a common size so that we can make a direct comparison. So you can do vertical common sizing or horizontal common sizing, but let's just look at this example here. Look at the bottom, total current assets. So we're going to take each account and divide that by the total assets to get a percent, much like we did in the income statement where the total revenue, that was the 100%. So here's an example from Nike, and this just gives you kind of an idea of the trend. Remember, I tell you this all the time, and we're going to do that here. Let me give you a heads up. We're going to do that with ratios, and I'll make that comment here again in just a second. Whenever you're looking at financial statements, whenever you're looking at the common size and financial ratios, it's important to do 2 things. Look at the trend. So here we have a common size trend analysis over a 4-year period in which you can take a look at what does, in this case, the left-hand side of the balance sheet look like over time. You know, current assets, 69% down to 65%. Non-current assets then have to go the other direction, right? 30% up to 34%. So that's really a cool thing about this common size, this commonality, is that you can do the trend analysis, and then you can take a look at Nike's competitors, you know, maybe Under Armour or Adidas, and you can take a look at the trends and compare those trends. I think those are great exam questions. Throughout the program, the Institute loves to ask ratio questions. I say that with evidence here. Look at those 15 questions at the end of this learning module. Half of them are, hey, compute this kind of ratio and then tell me what it means. So you'll need to remember these liquidity ratios. And so liquidity, simply ask the question, hey, what happens if everybody on the top right-hand side of the balance sheet shows up at the company's front door and says, I want my money today? Well, the current ratio, that's just the kind of the general one, current assets over current liabilities. That tells us really exactly how much the firm has in current assets to meet those current liabilities. But what we want to do is granulize that. Is that a word? What we want to do is we want to go ahead and say something like, well, let's not include all current assets. Let's just include cash, marketable securities, and receivables. We'll call that the quick ratio. If we just include cash and marketable securities, we call that the cash ratio. So you see how each one of these 3 liquidity ratios, each one gives us a sense of the company's ability to meet its short-term obligations, but at different kinds of levels, right? That cash ratio, how long would it take the firm to convert its marketable securities into cash to make those, look at the bottom right, extremely liquid assets, right? Well, go all the way up to the top. How long would it take a company to convert its inventory into cash? Well, that might take some time. So these give us kind of 3 different levels of measurements of liquidity. So imagine what I was saying earlier. Let's go back here to the common size so we can look at cash and equivalents and short-term investments and accounts receivable. So we can see that accounts receivable goes from 15% down to 8%. So that's about half over that 4-year period. Wow, we can make some concluding comments about the investment in accounts receivable, right? What do we want to do? We want to collect those accounts receivable as quickly as possible. So remember, I'm going to repeat this: trend analysis and then comparison against the competition. Now, the Institute then calls these solvency ratios. I'll go ahead and agree with that. I'd like to call them financial distress ratios or bankruptcy ratios, because these are long term. Remember, liquidity ratios are short term, and these things are long term. So this is measurement of the ability of the firm to meet not the top right portion of the balance sheet, but the top middle. How about if I just say the middle portion of the right-hand side of the balance sheet? So there you have a handful of ratios. I'd be able to compute those. And these things tell us about financial leverage and financial risk. So take a look at let's just do long-term debt to equity. So what does that mean? So in the numerator, those are probably long-term loans and bonds versus the equity. So the higher the numerator, the greater is the financial leverage and the greater is the financial risk. Let's take just a quick example of Prudential. So there we have 2020 and 2021. What has happened over time? Well, let's go ahead and compute the current ratio. There's 1.4. In this current year, 1.44. In the previous year, here's the total debt ratio, 6.7 to 6.7. So there's no reliance reduction on debt financing. So these are the kinds of questions that the Institute is going to ask. So now that we've completed all of these learning outcome statements, it's important, very important, that you go to those 15 questions at the end of the learning module. That you go to the end of the learning module, and those last 7 or 8 questions, they're all on this final LOS. So we spent lots and lots of time on all of these other LOSs, but make sure you focus on those financial ratios. So hey, thanks for watching. Have a great day. Good luck studying.